Hi, I'm Charlie Jamieson, Chief Investment Officer at Jamieson Coote Bonds, and this is a review of markets in November 2022. Major development for markets over the course of November was more certainty being provided from central bankers with regard to the pathway for their rate hiking cycles. Most importantly, the US Federal Reserve suggesting that they're going to now slow down the size of their hikes, although they do expect to continue on to quite a substantially high Federal Reserve funds rate in and around that 5% level. This certainty obviously will help lower volatility in the markets. And this has been something that's been very challenging for markets over the course of this year because of the uncertainty. But now that we have a pathway to some kind of peak in interest rates, that will help volatilities drop, and it will certainly be supportive of asset markets. And we saw that by very strong performance in fixed income over the course of November, both in domestic and global duration strategies. When we look at the forward inflation curve, it will fall very, very quickly, as we've talked about. This rotation of the base effect as the old historical higher data will fall out and be replaced by the current incoming inflation data. Where that inflation falls to should be above the Federal Reserve, should be below the Federal Reserve funds rate, somewhere between March and May of next year. And that's where the markets are expecting that the Federal Reserve funds rate will absolutely peak. And thereafter, there's probably a good chance that rates might actually get cut in order to help economies through the transition into 2023, where widely expected we will enter a global recession emanating certainly from Europe in the first instance. Here domestically, the RBA look very close to being done, in our opinion. Potentially one more rate hike in the February meeting date. But already, if we look at things like the GDP data, which is a little bit backward looking, but it came in at a 0.6, that only annualizes up to around about 2.5. That is not, an economy that is really booming anymore. It's slowed a lot from that reopening boom that it did experience, and the full gravity of the rate hiking cycle is really yet to feed through, given that very well-known monetary lag which occurs with monetary policy. Certainly, it's our expectation that after the Christmas period, where everybody wants to live their life and have a good Christmas after a few COVID-affected Christmases, into the new year, we think that the economy could start to slow quite rapidly, led by the consumer, who will be facing materially higher discretionary spending issues with regard to servicing their own debt loads into the higher RBA cash settings. So it's our expectation that bonds have certainly peaked in yields for now. They have enjoyed a pretty powerful rally. We think that they'll settle into a range here or hereabouts. We do not expect that it's easy for the central bankers to turn around and materially cut rates next year. They will still be very worried about re-stimulating inflation, and therefore it's worth thinking through what that means for your portfolio. If some of those safety nets that we've become very used to with regard to accommodative policy, that being rate cuts or quantitative easing, is a little further away this time. We certainly do expect that all economies will slow materially. Thankfully, in Australia, we're starting from a position of rude health, and we might not experience the full gravity of that recession that certainly those in Europe or the UK, then potentially the US will experience. Australia has its kind of own story where we should be able to have a softer landing. But certainly in terms of the bond market performance and for the pathway to policy, a pause will be a good development early next year, and absolutely expecting some rate cuts towards the end of the year. Remembering here in Australia, we have substantial fixed rate mortgages starting to roll off from those honeymoon rates that were available through COVID, and they will be rolling off into the 4s, 5s, 6s in terms of their resets in percentage terms. And again, that will bring an additional slowdown to the housing market and put more pressure on consumers as that is kind of transitioned into the economy, certainly from the second quarter onwards. We'll have a lot more to say in our next update about the year ahead, but we do thank you all very much for watching over the course of this year. It's been an extraordinary year in financial markets, a terrible year for fixed income as it's had a material reset from post-pandemic levels and post-pandemic policies. What that all means for markets in 2023, we'll have a lot of comment on next time around. Thank you very much.